Good afternoon and welcome to the Wealth of Advice market update on May the 1st, 2020. Another week has passed as we live through this current crisis. We've had lots of news this week, some positive, some negative. Boris Johnson, as I'd said last week, has appeared back on our TV screens. He's back in Downing Street. He's had his partner had another baby, so they think that's 6 children he's got, but we're not quite sure. However, he did announce yesterday that he feels, or the scientists feel, that Britain has now passed the peak of the COVID-19 outbreak. Very cold releasing us from this lockdown restrictions because they want to avoid a second spike of infections. This is what the whole world has got to be fearful of. The US, it frightens me the most. You saw a lot of Republican protesters getting into the courthouse in Michigan yesterday, protesting that it was their right to return to work. If you do see the infection rates go back up, then we could have problems. This is what's worrying. The reproduction rate, which we first mentioned on this presentation a good few weeks ago, the R rate has now come down to below 1. This has pleased the scientists in our country. They don't know exactly what the R rate is. There is a hell of a lot more testing going on. Matt Hancock wanted 100,000 tests to be done every day. He's probably speaking on the TV right now, saying that he's reached that total up to 80,000 yesterday, so I'm guessing they're almost there with that. The Americans on Wednesday said that they were really pleased about the remdesivir drug, and there'd been some positive results in their trials. We listened to our scientist today in Downing Street, and he wasn't as forthright as the Americans, but what he did say is that there is some positive signs that this drug is actually able to latch onto the virus and inhibit its growth. And once you've got that part underway, then you can sort of evolve from there. So you've got all the big, huge drug companies, AstraZeneca, are really, all of them all over the world. Oxford University researchers are really getting into this as well. And the Americans, obviously being the way they are, they announced Operation Warp Speed this week, where they're going to really try and get a virus vaccine sorted out in the next sort of 6 to 12 months, where they're going to chuck billions of pounds at this, hopefully try and test around 8 or 9 different vaccine options. Knowing fine well that 6 or 7 of them will probably be useless, and that'll be money down the drain. But out of those 8 or 9, they will come up with one which should provide a positive solution. So every week we have been talking about what fund managers say and what's been in the news. A lot of this stuff you'll have seen yourself elsewhere. So to try and change things up a little bit this week, we decided to put a few slides in about investor psychology, and then we'll look at sort of how the investments that we look after for our clients have performed over the last few weeks and months as we've gone through the worst of this crisis so far, and it looks like the markets have started to come out of it. The FTSE 100, for instance, in this week got above 6,000 again after going down to 4,950. So it's interesting to see how investors like yourselves will react through these periods of time. Some research was done previously, a lot before this crisis happened, showing that if you check the valuation of your investments every day, you're going to see a negative update at least 46% of times. So if you're logging every day, there's pretty much just under a 1 in 2 chance that you're going to see something negative from the day before. People don't like looking at negative things. If you reduce down the amount of time that, or the number of times you do log in and check your valuations just down to monthly, then you're reducing the amount of negative things you see down to 36% of the times. If you then only look quarterly, so 4 times a year, then you're only going to see a negative result 11% of the time. So the statistics show that investors who log in and view their investments a less amount of time than those who look more regularly will have better outcomes, because those who log in and check their valuations more often will often make emotional decisions and want to change their portfolio at times when they probably shouldn't do that. If you then look at how investors go through the different emotions of where they are with their investments, the time when they're feeling the most euphoric, so this was the 22nd of February this year. Obviously, those people who do watch news channels quite avidly, world news especially, would have been aware that the coronavirus was out there coming from China, allegedly to the rest of the world. But that was the point when investments were at the highest point. So the vast majority of people were euphoric at that time. We were having investment client meetings, annual review meetings with people, sitting down and showing them that portfolios had made 15-16% growth over the previous 12 months, and a lot of people were extremely pleased by that. Then as we got to the end of February, you could tell, as I say, people were certainly getting anxious over what was going on. Then the first week of March, we were into new territory where markets had started to fall quite quickly. I don't think we got a denial situation in the current crisis, because things just quickly snowballed down, and all of a sudden we're in the desperation stroke panic phase. And that was probably around about March the 5th through to March the 15th, when I was getting more calls from clients. What should we do? Should we cash our investments in? Is now the time when we should bail out? Will my investments go down to zero? Where is this going to end? And then the bottom, if you like, of the current period was around about March the 23rd through to March the 27th. And that would have been the worst possible time for a lot of people panicking about their investments. But that was actually the best time for people to start putting their money in. So at that point, the FTSE 100 was down to 4,970. As I say, on Wednesday, it was up to 6,100. So that's an increase of over 20%. Such an increase is therefore referred to as a bull market, and a bull market is a market that's in positive territory and would expect to remain so for a long time. Bull markets tend to last a good number of months and years, maybe. But as I say, we got to Wednesday, this high point was reached in our office. Discussions between myself, Amy, and Natasha Jordan, we were saying to ourselves, why has the market gone above 6,000 so quickly? Is it a safe place to be? And lo and behold, Thursday and Friday, UK markets, US markets, global markets have gone down a couple of percent on each day. And this has come out on the back of negative news stories regarding earnings of various companies. And you might sit there and think, well, it was quite obvious that you were going to see the earnings of all major companies around the world were going to be battered as a result of what was going on in the world. So markets are strange. Markets don't often act rationally. But it's interesting, as I say, that now that the markets have gone back up to this 6,000 level, the number of calls that we get from clients sort of panicking has gone down. And if you look at where this chart goes, maybe that's saying we're now getting back to the point where people have got hope and relief back in their belief system. But we're never too far away from getting to the point of where the markets are at a high point, which is when they ultimately might come down again. The one thing that we would always like to remind people is that markets will recover and markets will improve. If you were the lucky investor who invested money on this graph goes from the 1st of April, you would have had a good first month. You would have seen, and that's showing this again is our risk score 2 and risk score 3 investment portfolios. They were worth the risk score 2 86,419 on the 1st of April, and that one's up to 91,391 at the end of the month. This is the one which we're assuming if you'd had £100,000 invested the 23rd of February before the markets collapsed, that's the journey that would have taken. So it's all about time in the market rather than timing the market. For those people who are lucky to get in the market at a low point, that's all it is. It's luck. Over the long run, luck evens itself out. When we look at sort of actually how these portfolios have done over a 12-month period, I was speaking with a client this morning for their annual review, and while their portfolios are down, as I say, around about 10% from the end of February, if you actually look from May of last year to right now, this graph actually goes from the 1st of June 2019 up until the 1st of May, so over the last 11 months, you can see that the portfolios are only down around about 2.5-3% over that period. Obviously, where the investor psychology kicks in and what you're focusing on, and rightly so, you saw valuations go up from that point there. Would have went from 93,000 on June the 1st last year to just over 100,000 at the end of February. People will focus on where the valuations were at their highest point. We aren't concerned right now about where our fund managers have got clients' monies invested. We're quite confident that most fund managers have made the changes that we would have expected them, and we're pleased with the changes that they've made. The first chart here we can shows the Franklin UK Equity Income Fund. So this is a fund that only invests in UK stocks and shares. 12 months ago, its top holdings, as you can see, were 2 oil companies, Glaxo Unilever. The holdings in Royal Dutch Shell a year later are still there, but you can see that BP has now disappeared from that list, and the holdings in AstraZeneca and Glaxo have been increased. Obviously, they're two huge pharmaceutical companies. It's interesting that the holdings in a tobacco company's gone up. People obviously must be smoking their heads off through all of the stress and pressure that's going on right now. Unilever is a good, solid investment to put money into. Diageo, a drinks company. I don't know what your recycling box is like when it goes out once a fortnight, but mine certainly makes more of a jingle as we take it up the drive. So everyone's drinking more. So as you can see from that, the fund managers have changed their holdings over the last 12 months. The T. Rowe Price Fund, which invests in US large caps, so these are absolute monster companies that exist in the world. And again, you can see the same names are on both sides of this chart, really. But the huge technology companies, Microsoft has seen huge growth. We use Microsoft Teams ourselves more than we had done previously. Every laptop and computer that we have has Microsoft products on it which update automatically, and we pay a monthly subscription to them. Businesses all over the world are really engaging more into Microsoft. Amazon, as you're aware, we mentioned this previously, they've made a lot of money. Again, the one company at the end of March that T. Rowe Price no longer holds, which it was holding a year ago, is Boeing. Who would want to hold airline companies right now? A lot of them are going to go to the wall. Maybe get government bailouts. Ryanair in the news this week just saying there's no way they're going to make a profit. There's no way they're going to run flights where they make a loss unless the government fund this. Richard Branson crying out for aid for Virgin Atlantic. So the fund managers, as you can see there, have made some huge changes. Netflix is in there, Visa, people paying for things online, global payments. Alphabet is Asia's version of Amazon, so that's now got a much stronger holding in this portfolio. So over that 12-month period, the fund managers have really focused on quality stocks which have a good, strong balance sheet, rather than some may fall over as a result of the current downturn. This third fund that we're showing here is not a stocks and shares fund, it's a bond fund. Bonds are those financial instruments which are issued by companies in order to raise finance, issued by companies and countries. This is the Janus Henderson Strategic Bond Fund, and you can see there the big names that exist in there: United States Treasury, Orange, Barclays, Amazon, Microsoft. Not much change from the previous year. There's never going to be any airline bonds held in this and that sort of thing. But again, this is going to give all portfolios good core returns. So it's not just these individual funds, but then we look at the legal and general multi-index funds, the Royal London government portfolios. These fund managers are doing exactly the same to make sure that these stocks are the ones which are going to help bring the portfolios back up and bring that sort of line back above the 100,000 figure where it was at the end of February. How long will it take before we get above that figure? I do not know. Some people are predicting that we will see a W effect on this graph. That may be the case when, as I say, when the market got above 6,000 on Wednesday. My gut feeling then was that we will see markets come down a little bit before they go back up. The threat of a second wave of this virus really affecting economies is a big risk. But as I say, all those funds that you saw, the names that these fund managers invest into, they are there trying to make growth, trying to make profit, and hopefully, as I say, we come through the other side of this with healthy, strong companies that are going to provide some good returns. So thanks for listening to me again. Again, I'll end the presentation saying if anyone has any questions that they wish to put to us or to the fund managers, please ping them into my email address. Provided, as I say, as enough people continue to watch these updates, we'll do another one next week. So after 15 minutes there, thanks for listening and have a good weekend. Thank you, bye.